It's been a very dramatic week with a lot of news, and the markets have responded and have probably formed important cycle turning points. My name is David Hickson, and in today's market update we're going to be taking a look at the same three instruments that I discussed in last week's market update: the S&P 500, the Nasdaq, and gold. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. Let's start today's market update with a consideration of gold, and as discussed in last week's market update, I was expecting an 18-month cycle peak. I'm not going to be repeating that. If you haven't seen last week's market update, I would encourage you to take a look at it. There will be a link in the description below this video so that you can catch up on our analysis. The important thing, as discussed in last week's market update, was that we were expecting an 18-month cycle peak to form in gold. And I suggested that the fact that gold was reaching up towards an 18-month cycle peak might have been influencing stock markets, because of course all financial markets are influenced by one another. And we have the principle of commonality, which tells us that there is a great deal in common between all financial markets. Principle of commonality was defined by Hurst over 50 years ago, and it still applies to this day. As you can see, the current count since the really important trough in the middle of 2020 is 570 days since that peak. Did I say trough? I meant the peak, of course, that occurred in 2020. 570 days have elapsed. The average length of an 18-month cycle is 546 days, and if you don't understand why it is 546 days, then I would encourage you to download the 10 core concepts document that I will provide a link to in the description below this video. So on Thursday, triggered probably by some extra volatility in the markets because of news coming from the Ukraine about the outbreak potentially of war between the Ukraine and Russia. You can see that that occurred 566 days following that peak in 2020, and so it was only about 20 days late in terms of forming an 18-month cycle peak. It is my opinion that that 18-month cycle peak has probably formed. Of course, we cannot absolutely confirm it until we receive confirmation from one of our cycle tools, which means that we need price to cross down below a VTL or an FLD. A useful FLD to keep an eye on is the 20-day FLD. You can see the FLD is dashed on this chart, and that is because I am plotting the FLD based on the peak analysis. I speak about this every time I speak about gold, but you can see that there are two analyses on this chart. At the top of the chart are the results of a peak analysis, which assumes that the cycles that influence the markets or the price movement are synchronized at their peaks. And at the foot of the chart are the results of an analysis that assumes that the cycles are synchronized at their troughs. It is impossible that cycles be both synchronized at their troughs and their peaks. It is mathematically impossible. And so either one or the other must be the correct analysis. It's an interesting thing that some markets seem to fluctuate between cycles that are synchronized at their peaks and cycles that are synchronized at their troughs. That's a subject for another video because it's a fairly in-depth discussion. But the important thing about gold is that I believe that it is influenced by cycles that are influenced at their peaks and not at their troughs, which is why I often, in fact, hide the trough analysis, but I'm sure that you are more than able to ignore the trough analysis for the moment. The important thing is that I am watching the 20-day cycle FLD based on the peak analysis. And as you can see, that FLD is right down at the level of the pre-market action, well, pre-US market. I'm recording this video before the US markets open on Monday. And you can see that price has come down and just touched that FLD. When price crosses down below that FLD, we would have confirmation that a peak of at least 20-day magnitude has formed in the markets. 20-day magnitude is not a very big magnitude peak, but because of the principle of synchronicity, which is telling us that these peaks are synchronized, on the assumption that the peaks are of course synchronized, then the fact that we get confirmation that there is a 20-day cycle peak will also confirm the 40-day cycle peak and the 80-day, 20-week, 40-week and 18-month, because of the fact that we are expecting an 18-month cycle peak. And so it seems very likely that that 18-month cycle peak has formed in gold, and we are going to be watching the FLDs for confirmation of that. Let's take a look at what the implications of that are. Of course, following an 18-month cycle peak, we expect price to move down, because that's what happens after price forms a peak, is it moves downwards again. And this is where the trough analysis might come in handy, because we can see an 18-month cycle trough looming in about July of this year. And so that might provide us with a good place for gold to move down to. And another way of visualizing the analysis is to display the composite model line, which I'm going to do here. That is the dashed orange line. The composite model line simply takes all of the cycle information contained in the analysis, or in this case contained in both the analyses, both the peak and the trough analyses, and it combines that information, which is of course information about the cycle wavelengths and their amplitudes. It combines that information and produces this composite model line. In the past, it shows us what would have happened to this price if the only thing influencing the price had been the cycles that have been found in the analysis. It is a means of determining the accuracy of your analysis, if you like, because, of course, the better a composite model line fits the price action, then the better the cycle information describes what has been happening in price, and therefore is a gauge of the accuracy of your analysis. Then the composite model line assumes that the cycles are going to keep beating with the same wavelength and the same amplitude, which is a flawed assumption, as I often mention when I discuss the composite model line. Because of the principle of variation, we know that the wavelengths and the amplitudes of all of these cycles are going to vary. Nevertheless, it gives us another way of visualizing the analysis, and the important thing, as I think you can see from this composite model line, is that we are expecting the peak now, and then price is going to move down into a trough over here, which will of course be where the 18-month cycle trough is expected to occur, on the assumption that there is some validity in the fact that the analysis performed on the basis of cycles synchronized at their troughs, that there is some validity to that analysis, which could be discussed, but we're not going to spend the time doing that now. The important thing is that the price of gold is expected to decline. So let's take a look at the stock markets and see what has happened to them. Let's start with the S&P 500, and I've been discussing this analysis in many market updates recently. As you know, I think there is a good chance that the 18-month cycle trough formed at the beginning of October, and there were then 146 days since that cycle trough formed in October. The average length of a 20-week cycle is 136 days. And so that 20-week cycle trough, if that was indeed a trough of the 20-week cycle, formed about 10 days late. It is my opinion that it is very likely that this is the trough of the 20-week cycle that has formed over there. We have a very neat nest of lows, and there is a potential trough as price came down on the news of what was happening in the Ukraine, and then bounced straight back up again. The news gave us the extra volatility to actually give us a sharper trough in that position. I'm not going to discuss the interaction between news and fundamental events in the markets in today's video, although I'm strongly tempted to, but it's a very big discussion and we'd be here for several hours. So suffice to say for now that it is my opinion that the 20-week cycle trough probably did form over there. As you will know, if you've been watching these market updates, I had been discussing the possibility that the 20-week cycle trough had formed over there. And in a moment, we're going to take a look at the possibility that that was, in fact, what happened. It's a fairly bearish possibility, but we're going to take a look at it because we do need to bear it in mind. Now, you will also know that in recent market updates, I have suggested the possibility that, in fact, the trough that formed last week, or the trough that we were expecting to form last week, I should say, was not of 20-week magnitude, but was, in fact, perhaps this 18-month cycle trough forming very late. So let's take a quick look at that. Here is that analysis, and you can see that according to this analysis, the trough in October was of only 20-week magnitude. We therefore have the same number of days that elapsed, 146 days, until this nest of lows over here, which you can see is a very ragged, jagged nest of lows. If we join the dots between the circles, you can get a better idea for what I call the center of gravity of that nest of lows, which is when that trough was really expected. And so we have the formation of a fairly apparent trough at about the time that, according to this analysis, an 18-month cycle trough was expected. Let's just zoom out and consider this analysis, or this possibility, from a slightly wider perspective. Here is the longer-term view, and I know that there are many cycle analysts who disagree with it, but it is a very intriguing possibility that the March 2020 trough in the S&P 500, which occurred early. If you go back and look at the market update videos I was recording at the time, I was expecting the trough to occur, I think, in June, so it occurred about 6 weeks or perhaps 2 months early in the US markets and the stock markets around the world. And the intriguing possibility here is that the more important trough was in December of 2018, and that this distorted movement was again influenced by news. So we've already been mentioning the news in today's market update because of what's happening in the Ukraine. But of course, the outbreak of a pandemic is also news, and it will affect financial markets. And so the intriguing possibility here is that the formation of that trough in March of 2020 occurred fairly early, or earlier than it should have, because of the news events at the time, the outbreak of the pandemic. And you can see that there have been 1,160 days, or 38.1 months, that elapsed between the December 2018 trough and last week's low price, which is also potentially a trough. And so half of that is, of course, 580 days, which is not very far out from the 546 days that you would expect in an 18-month cycle. And so is it possible that 2 18-month cycles have elapsed during this period of time, but the middle trough, if you like, or the trough that formed in March of 2020 was displaced because of the fundamental interaction, because of the news? It's an interesting concept. I'm not going to insist one way or the other, but it certainly raises the possibility that the trough that we experienced last week was a trough of possibly 18-month magnitude. In practical terms, it doesn't make very much difference to me because of my trading time frame. The important thing is that I believe that the market is bouncing out of either a 20-week cycle trough or an 18-month cycle trough. And again, I am going to be taking a look. I'm going to be watching the FLDs, and I'm going to be looking for confirmation that the trough has formed as price crosses above these FLDs, or potentially finds resistance at the FLD and keeps moving downwards. So we're going to be watching the FLD here as well for confirmation that the trough has formed. Let's take a very quick look at the composite model line according to this analysis, which of course assumes that the March of 2020 was a 54-month or possibly even longer cycle trough. And so what we have seen elapse into the recent trough was the first 18-month cycle. And let me display the semicircles. It helps us to visualize this analysis. Then we would have a second 18-month cycle, and then of course a third 18-month cycle, bringing us into the big 54-month cycle trough that we would be expecting in late 2025 according to this analysis. And so you can see that according to this analysis, we've had a very nice big bullish 18-month cycle, then we would expect a fairly neutral 18-month cycle followed by a bearish 18-month cycle. How does that compare to the other analysis? Well, here is that other analysis with the 18-month cycle trough in October of last year. And again, we have our 3 18-month cycles that need to elapse to bring us into the next 54-month cycle trough, which is, according to this analysis, going to occur just a little bit earlier, perhaps in about mid to late 2025. You can see that, of course, here again we have our first bullish 18-month cycle, which was what elapsed over there. Then we are expecting a fairly neutral shaped 18-month cycle, and then finally a more bearish 18-month cycle. Now you'll notice that the composite model line, according to this analysis, isn't quite as clear in terms of the shapes of those cycles, and one of the reasons for that is because of the recent discrepancy. And that was what I thought would be worth pointing out. According to this analysis, you can see that we have a discrepancy. Here is the composite model line coming down to a low position for the 18-month cycle trough, of course. And then the first 20-week cycle trough, which is the potential trough that formed last week. There's the nest of lows. Should, according to the composite model line, and according to all logic surrounding the cycles that influence these financial markets, should have occurred at a higher level, because following an 18-month cycle trough, you would expect the first 20-week cycle trough to be a fairly bullish one. And there we can draw our M shape, and that is where there is an anomaly according to this analysis, because of course that 20-week cycle trough occurred at a lower price level. That's an interesting anomaly, and in a moment we're going to take a look at the Nasdaq and see if there are any potential bearish implications to that. It is worth pointing out, I think, here that the drop down below the 18-month cycle level was a fairly quick and sharp one, and of course it was accompanied by news. And whenever you get a new extreme level accompanied by news, some of that can be attributed towards the volatility that news always creates. But it is nevertheless worrying that we have seen a fairly bearish cycle shape develop. So let's take a look at the Nasdaq and see what the possibilities are there. The Nasdaq, as I have discussed in recent market update videos, is interesting because of the fact that the March 2020 trough did not reach down to a lower price. And so the default analysis, or the fairly obvious analysis for the Nasdaq, places the big cycle trough over here in December of 2018, which is of course what we were discussing in one of the analyses in the S&P 500, on the assumption that the pandemic outbreak caused a distortion and therefore a lower price in March of 2020. The important thing here is that in terms of our 3 18-month cycles, we have now seen the completion not of the first 18-month cycle since the very important cycle trough, but the second 18-month cycle, which means that the third 18-month cycle is the one that is currently underway. And of course, we would usually expect this first cycle to be a bullish cycle. Then we would expect the second 18-month cycle to be fairly neutral. And the third 18-month cycle should then be the bearish one, as we have discussed in the charts we were looking at for the S&P 500. And so that would make some sense out of the fact that the markets have turned bearish with this recent 20-week cycle. And so this is a possibility that we definitely need to keep our eyes on, the possibility that the markets are turning bearish and that we are now moving down into the next 54-month cycle in the Nasdaq, and possibly even in other stock markets, because of course the stock markets around the world are all closely related. And so we definitely need to keep an eye on this possibility that the markets are turning bearish. But the interesting thing about the composite model line, which of course takes all the information from the analysis, recombines it, is that we are seeing a discrepancy coming in terms of that possibility, which is that the composite model line nevertheless expected this first 20-week cycle to be more bullish than bearish, and that in fact the bearish drive down into the 54-month cycle trough expected, according to this analysis, in about March of next year, is not going to be as strong as might be expected. So that's a really interesting consideration. Let's take a look at the other possibility, which is that the 18-month cycle trough is the trough that has recently formed here. And here is that possibility. You can see that we have our big 54-month cycle trough in December of 2018, the 18-month cycle trough in March of 2020, and here is the very staggered nest of lows for the 18-month cycle trough, because I have influenced this analysis asking Sentient Trader if it is possible that the 18-month cycle trough has only occurred over here. Of course, that makes it an impossibly long 18-month cycle trough, or I say it's impossibly long. There are many analysts who would consider 700 days to be an impossibly long 18-month cycle. It is only just within the realms of possibility, but it is certainly a very long 18-month cycle. Is it possible that, again, the pandemic has caused a little bit of fundamental interaction? Yes, it is possible, but I tend to favor the previous analysis that we were looking at. The interesting thing about this analysis is that if we take a look at the composite model line, which you must remember simply gives us another way of visualizing the information in the analysis, then we see a fairly strong discrepancy between price action and the composite model line. In particular, you can see the peak of the second 18-month cycle, according to the cycle information found in this analysis, should really have occurred in early 2021 and not over here in November or December of 2021. And so we have a complete contradiction between the composite model line and price action for that period of time. Of course, we have seen price moving down as the composite model line expected over there, but that discrepancy between the composite model line and price highlights a potential problem in this analysis, and so I don't favor this analysis because it requires too many distortions in terms of the analysis that we are performing. But I'm showing it here because we've had many questions about whether this is possible. Finally, I'd like to take a look at a third possibility in the Nasdaq. I try not to present too many alternatives, but there are only subtle differences between these possibilities. And this one was suggested by somebody who wrote to us asking whether it was possible that the 20-week cycle trough had formed in the previous position that we were speaking about. Where was that? Back in January. In fact, let me zoom in here so that we can take a closer look at this possibility. Here we go. And so the idea was that it was possible that the 20-week cycle trough occurred early over here on the 24th of January, as discussed in previous market updates. And if we measure the number of days there, you will see that there were 112 days that elapsed from the trough in early October until the 24th of January. I discussed this in previous market updates, the possibility of an early 20-week cycle trough forming over there. That was, of course, a bearish cycle trough, and we can draw the M shape. There you can see it's a fairly bearish M shape because of the fact that the trough at the end of that M shape is lower than the trough at which the M shape started, which by definition makes it bearish. In terms of the position of the peaks, we had a slightly earlier peak, which is another bearish sign. And so we had a potentially bearish 20-week cycle trough that elapsed. Is it then possible that what we have seen happen since the 24th of January is nothing more than a bearish 40-day cycle? Because you can see, according to this analysis, we have a nest of lows for the 40-day cycle trough over here. And so is it possible that the bearishness is accelerating? Well, it's an interesting possibility. I think it's fairly unlikely. And again, we need to keep a close eye on our FLDs in order to monitor the possibility of this analysis taking place. Let's just hide our semicircles and display some FLDs here. And if we zoom in again, you can see that we can watch this possibility very closely because price is right now at the level of the 20-day FLD. We're going to be watching to see what happens as price encounters that FLD. And let's also display the 40-day and the 80-day FLDs. We're going to certainly watch very closely to see what happens as price encounters each one of these FLDs in order to confirm the magnitude of the trough that has formed. But the interesting thing, if we zoom out again and apply the composite model line based on this analysis, here is the interesting thing about this possibility. We have our first 18-month cycle, our second 18-month cycle, and now we're in our third 18-month cycle. And you can see that according to the cycle information contained in this analysis, we would have in fact expected price to come up and form another peak and only then start its move down into the 54-month cycle trough expected in early 2023. Is this possible? Is this analysis possible? Are the markets turning bearish? It is just possible. It is the least likely analysis in my opinion, which is why I have left it to the end of the video, so that in case you lost interest before you reached this point, you wouldn't be overwhelmed by the possibility of the markets turning suddenly bearish. It is the least likely possibility, but it is certainly one that we need to keep our eyes on. I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.